So we continue with our discussion of bonds. Earlier on, I'd indicated the relationship between the values of the bonds and the interest rates. And we saw that there is a relationship. And that's exactly what we are talking about on this particular slide. So when the market interests, or market interest rates, or the yields fall, the market price of bonds rises. In other words, to calculate or to estimate the market value of the bonds, we are using the concept of discounting. And the interest rates or the yields are our discount rates. So indeed, it's true that when the discount rate drops, the present values increase. So on interest rates or the discount rates, when they drop, what will happen is that the present value of the bonds fixed future cash flows will rise. In a similar way, when yields rise or discount rates go up, the price of the bond falls. And the change in the bond price is approximately the same in either direction. However, it's got to be for small changes. It's got to be for small changes in the yields. If there's a very big change, then the impact on market values may not be exactly what is estimated or forecast by the relationship that you have here. For larger changes in yields, the change in price is greater for falls in yields than for rises in yields. Therefore, the relationship between yields and bond prices is not linear, but convex. And this is what we saw earlier on when I was illustrating to you. Remember what I told you? The relationship. Yes, we showed the relationship that if you put your price here and you put the interest rates there, as you increase the interest rates, the market value of the bond drops, but they don't drop in a straight line, they drop something like that. So this relationship between the price of your bonds and your interest rates or the yields. And that's what we'll be focusing on this afternoon. So then, there's a small example here. Please have your calculators ready so that, like we did last time, you keep on confirming these figures. How much would an investor pay to purchase a bond today, which is redeemable in 4 years' time? So this bond is redeemable in 4 years' time for its nominal value or face value of 100 and pays an annual coupon of 5% on the nominal value. The required rate of return or the yields for a bond in this class is 4%. So that's your discount rate. You've got your cash flows determined by that coupon rate, and you've got the nominal value on which the interest is paid. So what have we said again? How much would an investor pay? In other words, what we are saying is, what is the market value? What is the market value? That's what we are asking for. Or what is the price? What's the market value or what is the price? Answer, you discount. As with any asset evaluation, the investor would be willing to pay at the most, the present value of the future. So it's the present value of the future income stream discounted at the required rate of return or yield. Thus, the value of the bond can be determined as follows. So this particular bond, how much will be the interest every year? For the next 4 years, how much is the interest? The interest is 5%. This one, coupon rate. So the interest that you'll be buying will be 5% multiplied by $100, giving you $5. So that's the interest that you are receiving. This is the benefit that you are buying for the next 4 years. And in the final year, we give you your 100 plus the interest of 5. That is why we are saying it will be 105. That is why we are saying it will be 105. Then we discount this at 4%. Where is the 4%? The 4% is here. So discount at 4%. Now some of you may say, but what is this 1.04, Mr. Piri? This 1.04 is a discount rate. It's 1 over 1.04. Now, if you want to bring it on top, it becomes what? This to bring it on top is 1.04, the power minus 1. So this is the same as that. So what you see here, this is a minus 1, that's a minus 2, that's a minus 3, and that's a minus 4. Now you're learning something. So please take your calculators. Take your calculators and you prove. You say 1 divided by 1.04. What answer do you find? Somebody to share the answer, please. Somebody to share the answer. One divided by 1.04. What is the answer? I'm waiting for the answer. 1 divided by 1.04, what's the answer?
It's 0.9615.
Okay. 3 decimal places,
0.962.
962. Now we just want to learn this so that in the exam you pass. Now they say another way of writing this, you bring it using 1.04, the power minus 1. Please take your calculators. Your calculators can do this. You just say 1.04 to the power minus 1. Just check that you're getting the same answer. Can somebody confirm that you're getting the same answer? (1.04) the power minus 1. Are we getting the same answer?
Yes.
Yes, sir.
Good. So remember, you know your exam, we need to be versatile. This exam is so much time pressured. So we need the versatility, we need to do some shortcuts. And most of the computations will hover around this discounting, compounding, and the like. So if we can have more ways of doing this, that will be very helpful for us. So that's a discount factor. What for the following year? Again, 1.04, the power minus 2, and you go on that way. Okay. So when you discount this, we're finding that the market value of this bond is 89.75. Where is this? Sorry, not 89.75. Let me just take out the rest here. Yeah, so the market value of this bond is, you add this present value, that present value, plus this present value, plus that present value, plus that present value gives you 103.62. So this is your market value of the bond. So that's the market value of the bond. So that's how much you must pay for this bond. So this is the maximum that you can pay, the present value of the benefits. So that's the maximum that we can pay. Okay. Let's continue with our discussion. If the required rate of return or yield was 6%, if now you discount it at 6%, remember earlier on the yield were at 4%. So we're saying if now the discount rate increases to 6%, using the same calculation method, the price of the bond was 96.53. It will now drop. And where the required rate of return is equal to a coupon rate of 5%. Remember, the coupon rate of this bond was what? The coupon rate based on which interest was paid was what? Was 5%. So if the yields or the required rate of return by the investors is also 5%, what will happen? When we discount the cash flow this time, what are you going to get? You're going to get 100. So what lesson are we getting? We're looking at how to value bonds. Thus, there's an inverse relationship between the yields of the bond and its price or value. The higher the rate of return required, the lower the price of the bond, and vice versa. So remember, we are saying that we had a situation here. If you discount at 6, the value that you get getting closer to your exam question. So in your exam question, they have introduced the concept of a spot yield. So that's the concept that we want to learn about. They have introduced the concept, and the concept is called a spot yield curve. So this is the concept that we want to learn about. What do we mean by the spot yield curve? What is a spot yield curve? And how does the concept of the spot yield curve work? and today. So what is a spot yield curve? That's a concept that we want to talk about. A spot interest rate is the rate for borrowing a sum of money today. A spot interest rate is the rate for borrowing a sum of money today to be repaid by a single sum on a specific future date. So you borrow money today, okay, and this money is going to be paid by a single sum on a future date. So what is this interest rate? This interest rate is what we call a spot interest rate. It is calculated by finding the discount rate that makes the present value of a zero coupon bond equal to its price. Some of you may say, Mr. Perry, that is not clear. What is that? Let's do a small illustration here. 0, 1. So you want to borrow money today, and there's nothing that you're going to receive here or that you're going to pay here. The whole amount that you borrow today will be paid back in one payment here. The whole amount we paid all at once. So let me just put that again for you. Let me put that again for you so that we understand what we are talking about. Here's a point in time. This is today. We borrow an amount. And you're going to pay the whole of it 1 year from now, plus the interest. So this interest rate payable on this amount that you borrow today, and the whole amount we paid 1 year from now. The interest rate that we're charging you, we're calling it a spot interest rate. So what is the interest rate then? Answer. It is calculated by finding the discount rate that makes the present value of a zero coupon bond equal to its price. So we're saying this is a zero coupon bond because there's no interest being paid here. The whole of this amount will be paid Our internet is really, really poor today. Let's hang in there. Hopefully to improve on the way. Hopefully it will improve on the way, but it's quite very poor. We can't complete our thought. We can't complete our thought. So this amount, we can calculate the interest rate here, which is applicable. What do? We simply take this amount. We simply take this amount and we discount it. Once we discount this amount, it should give us this figure here. And that's what we'll be doing. Eh? Don't panic, that's what we'll be doing. For example, the 1 year spot rate is the rate for borrowing money today to be repaid with a single amount after 1 year. The 2 year spot rate is the rate for borrowing money today to be paid to be paid with a single sum after 2 years. Have you followed the story? Because that's what we'll be calculating today. A 1-year spot rate is the rate for borrowing money today to be paid with a single amount after 1 year. A 2-year spot rate is the rate for borrowing the money today to be paid with a single sum after 2 years. Now, these are investments which do not pay interest. The investments that we don't pay interest in between. An investment where when you invest, you don't pay any interest. You don't pay any interest. What is payable is just a lump sum. Let's say after 2 years is what you call a zero coupon bond. Zero coupon. Why? Because there's only one cash flow, which is at the end of the investment. That's the concept of the zero coupon. Ideally, spot interest rates could be found directly as a quoted yield to maturity of zero coupon bonds of various maturities. So if we could identify these zero coupon bonds, we can just pick the spot interest rates from there. But for the purpose of our exam, we need to learn how to calculate. However, in practice, most government bonds and are not repaid as a single sum. In this case, spot rates cannot be directly observed and have to be implied using the process known as bootstrapping. The bonds that we have, we do not have the zero coupon bonds. Most of the bonds pay a coupon. Therefore, we can't just read out this spot interest. We need to learn how to calculate. Why should we learn how to calculate that? Let's continue. Valuing bonds on the yield curve. Annual spot yield curves. Now I'm sure I'll remember of an idea of what a spot rate is. Annual spot yield curves are often published by the financial press or by central banks, such as the Bank of England. So these spot yield curves, which are interest rates involving transactions where an amount is borrowed today and the lump sum is paid at the end. The interest rate applicable is normally given by entities such as the Bank of England. Okay. Now let's continue. What is the application of the spot yield curve? Why should we know about spot interest rates? A company wants to issue a bond that is redeemable in 4 years. Now look at this. You're a company, you want to issue a bond redeemable in 4 years for its nominal value of 100. It's a new bond. It's a new bond. And wants to pay annual coupon of 5% on the nominal value. Estimate the price at which the bond should be issued. Now, the other bonds that you have come across, they're existing bonds that are running. Now, we want to issue a new bond. We want to go and sell bonds in the market to raise some money. What is the price of those bonds? Some of you say, but won't we discount? Yes, we're going to discount. That's okay. But what are we going to discount? Because, one, do we know the yields? What are we going to discount? And this is the question that came in those past papers that now we must learn how to find the market value in this situation. So how do you find the market value? A company wants to issue a bond that is redeemable in 4 years for its nominal value or face value of 100, and wants to pay annual coupon rate of 5% on the nominal value. Estimate the price at which the bond should be issued. Here are the points now to take note of. Number one, an accurate approach to bond valuation is to strip a bond, to break down the bond into its constituent cash flows and discount each cash flow separately at each related spot rate. An accurate approach to bond value is to strip a bond into constituent cash flows and discount each cash flow separately at its related spot rate. So we're going to break down the bond. What does that mean? Don't panic. We'll demonstrate to you what it means to break down the bond. And you notice that it's so straightforward. The annual spot yield curves, the annual spot yield curve for a bond of this class is 3.5, 4%, 4.7, and 5.5. Now, do you remember what a spot interest rate is? Are we able to interpret what this means? Are we able to interpret what this means? Let's interpret these spot yield curves. Remember what we said? If we as a class we go and borrow a bond, and we are going to make one lump sum repayment 1 year from now, will be quoted an interest rate of 3.5. If we as a class we go and borrow a bond, we go and borrow money, and we are saying that we are going to make only one payment, we're going to pay back in 2 years' time in the lump sum payment, they'll quote 4% per annum for us. Number three, what does this mean? If we as a class we go and borrow money and we are told that your annual spot yield is 4.7, what does it mean? It means that we borrow money for 3 years, and in between there will be no interest payable. We're just going to pay one lump sum payment at the end of 3 years. What is the interest rate? The interest rate to be quoted will be 4.7 per year. So I hope we now are able to calculate or to understand what the spot interest rate is. So I've been given this spot yield curve. Remember, what do we want to do? We want to find the market price of this new bond here. And we have been given that the annual spot yields are here. So to start with, this 4-year bond, and based on the wishes of the company, the company wants to pay interest at 5%, like that. Step number one, we strip this, we break down this into the individual cash flows. This bond can be broken down into this pattern. It's like there are 4 bonds in here. One bond with a cash flow in year 1, another one in year 2, another one in year 3, another one in year 4. This is what it means to break down this bond, or to strip this bond into the individual cash flows. So that's the step number one. We want to find the market value of this bond. So step number one, what do? We take this bond and break it up into 4 separate bonds. 4 separate bonds. Where has the 5 come from? Let's just revisit the 5. The 5 is here. That's the interest rate you want to pay. Where of the 100? The 100 is here. That's the redemption amount we want to pay. That's where these figures have come from. Next, each annual payment is a single payment in that particular year. much like a zero coupon bond. And its present value can be determined by discounting each cash flow by the relevant yield curve rate as follows. Where are these coming from? The relevant yields are here: 3.5, 4%, 4.7, and 5.5. So we're going to get the discount factor. What's the discount factor at 3.5 in year 1, 4% in year 2, 3%, 4.7% in year 3? What is it? That's what we have here. Now the minus is not an issue, isn't it? Is the minus an issue anymore? No. At the beginning of this lecture, we discussed this minus. We discussed this minus. We discussed this minus at the beginning of this lecture. So these are the discounting factors. So that bond now is being discounted as 4 separate bonds with these values. And now when you multiply these amounts by the discount factors, you have now 4.83, 4.62, 4.36, and 84.76. So the market value of all these cash flows, or the present value, is 98.57. 98.57. This is the price at which we're going to sell this bond in the market today. This is the price at which we're going to sell this bond, 98.57. The sum of these flows is the price at which the bond can be issued, 98.57. Let me take down back to statement. I want to take note of this statement here. An accurate approach to bond valuation is to strip a bond into its constituent cash flows and discount each cash flow separately at its related spot rate. So the correct way, or the most accurate way of estimating the market value of the bond, is to discount the cash flows involved in a bond separately. The correct approach, the accurate approach to bond valuation is to strip a bond into its constituent cash flows and discount each cash flow separately at its related spot rate. So this is what is supposed to happen if we're accurate, but to be accurate. Now, your next question is, so these figures here, the annual spot yield curves figures, where will they come from? Will they be given into the exam? The rest of this discussion is you understanding where these figures come from. Now, look at this statement very carefully again. Look at this statement. The annual spot yield curve for a bond of this class, risk class, these figures have been processed for you. This particular bond, based on its risk, these are the figures. So these figures have been processed. They're now specific to a company with a particular risk profile. So I want you to take note of these. These are things that you need to distinguish in questions. So for a bond of this risk, for this company, these are the yield curves that are applicable. And some of you are saying, so how did they get these? How did they get this? Do you remember the credit spread? Do you remember the method of finding the cost of debt using the credit spread? Risk-free plus what? Risk-free plus what?
Plus spread.
Yes. So what it means is that how these were found was they got the risk-free. Then they added the credit spread to arrive at this. Now, some of you may say, Mr. Pili, we have forgotten. No, don't panic, because that's what we are doing this afternoon. This afternoon, our major lesson is how to find these rates, understanding what they mean, and applying them in estimating market value of the bond. That is our lesson. So do not panic. If you feel that you are behind, don't worry. By the time we end, we would have put you at the same level. Now, estimating the yield curve. There are different methods used to estimate a spot yield curve. And the iterative process based on bootstrapping coupon paying bonds is perhaps the simplest to understand. Some of you may say that statement doesn't sound true, because the statement itself sounds difficult to understand, isn't it? Yeah, you may feel that way. But in no time realize that no, this language of bootstrapping simply means working backwards. To bootstrap simply means to work backwards. To work backwards so that we find the missing figure, that's all. What does that mean? Let's go through this together. A government has 3 bonds in issue that all have a face or nominal value of 100. Now remember, the government is the starting point. That's why we get the risk-free. So the government bonds give us a starting point. So the government has got how many bonds? Let's go. 3 bonds in issue that all have a face or nominal value of 100. And that is redeemable. One of the bonds is redeemable 1 year. Another one is redeemable 2 years. Another one 3 years. Since the bonds are all government bonds, let's assume that they're of the same class, and it's true. The same risk class. The risk class will be the same. Let's also assume that coupons are payable on annual basis to make our work easy. Bond A, which is redeemable in a year's time, please take note of that. The first bond is called Bond A. This bond is redeemable 1 year's time. What's the coupon rate? The coupon rate is 7%. Another bond is trading at what? This very bond is trading at 103. Bond B is redeemable when? 2 years from now. The coupon rate is 6%. The market value is trading at 102. Bond C, redeemable in 3 years. The coupon rate is 5%. And it's trading at 98. Now, some of you may say, hey, this data is difficult to follow, isn't it? What if we put it this way? The same data, we put it this way. Is it easier to follow now? Bond A, Bond B, Bond C. The coupon rates are here. The market value are here. Determine the annual spot yield curve. Annual spot yield curve. So we want you now to find the annual spot yield curve. From this. So how do we find it? This is a must exercise. This exercise is now a must. For those 2017 questions, this is what we must all be able to do. So this is a must know. Is it difficulty? Not at all, not at all. So let us analyze these bonds one after another. So 103, that's the market value. How is the market value of the bond estimated? Well, you can argue that I think I know how we do that. All we do is say there is year 0 there, year 1. This particular bond expires 1 year from now, and it doesn't pay interest. So let's go. What happens? The coupon rate is 7. So in 1 year's time, this bond is going to give you 100 redemption amount plus the interest of 7. Give us a total of how much? 107. So we're saying this bond is trading at 103. So there's a discount factor which we don't know. So this figure multiplied by the discount factor, which we don't know, which we are looking for, should give us how much? 103. Let's just focus on the first one alone. So the meaning of this bond here, the meaning is there's a bond whose market value is 103. The coupon rate is 7. And this bond is what's the discount factor that we are talking about here? So I want you to work out the discount factor for me. So let's go again. Let's go. Here, we've got a bond which will be redeemed 1 year from now. The coupon rate is 7. And therefore, in 1 year's time, this bond is going to get that, plus giving us 107. This amount is what is receivable a year from now. Now, once you discount this, multiply this by the discount factor, which you don't know, it should give you 103. So what is this discount factor, people? What is this discount factor? Can somebody work out what the discount factor is?
So when we divide, we are getting 0.963.
Please, can we all confirm that the discount factor, which can give us 103, is 0.963? Can we all confirm?
Confirm is 0.963.
Confirmed.
Excellent. Excellent. So if the discount factor 1 year from now is 0.963, this is a discount factor. What discount rate can give you this discount factor? That is the answer we are looking for. That's the spot that we are looking for. The spot rate that we are looking for. The spot interest rate is the interest rate which can give us a discount factor of 0.963. Now, a number of you know that. How do you find the discount factor? The discount factor is 1 over what? So then what is this interest rate that can give you 0.963? Let's work out together. Do not panic. Let's work out together. Let's find out what is this interest rate. What is this interest rate? So I want to work together and find this interest rate. Okay, fine. So what you're going to do now is we're going to make our life easy. We just invent this. What do I mean? Some of you may say, Mr. Perry, we have forgotten how to invent. Yeah, You turn this down, and this one goes on top. Again, remember this is like there's a 1 here, so you turn it again. So what do we find now? We find then that if I turn this one, I have 1 plus R. I turn this one, what does it become? It becomes 1 over 0.963. Please, can somebody now give me my answer here? 1 divided by 0.963. What is the answer? One divided by that, what is the answer?
1.038.
Another number, 388 or 387?
384.
384. So what is the interest rate then? 1 plus this gives us this. So you bring 1 on this side. You bring this one on this side. So the interest rate that you're looking for is what? 0.0384. Or you're looking for 3.84%. Do not panic. We're going to talk about this a number of times so that we understand it. So the discount rate, which is being implied by the first bond, is 3.84. So 3.84 is a discount rate which gives us 0.963. So you have got the first item there, you got your first discount rate. First discount rate, 3.84. 3.84. Okay, so we go for the first year. Let's come here. Here we are. The 1-year treasury note will produce a single future sum of 107 after 1 year. Therefore, its yields equals the 1-year spot rate, S1. So that divided by that minus that, 3.88 or 3.84 that we bought. So that was the first one. What of the second one? How do you find the second one? Let's build our own computation. Let's build our own computation. Let's not just copy there. So the first one now, we are saying that we've got a bond 0, 1, and 2. This bond, 1 year from now, it will give you how much? Then and then you've got your with our internet, but we are almost there. So now we are saying the second bond, then we are saying there are discount factors. Now for that one, we have already established. That was 0.963. This one is what is now missing here. So we're going to discount. Once you discount, the answer is 102. So that multiplied by that, that multiplied by that, when you add up all this, the answer is 102. So these are your present values. So we know that the present value of that one plus here gives you not 102, which is that one there. So now let us do our computation. What this one come from? You have already calculated that for this one is 3.84. You have calculated a discount rate already. So that's the one that we're using. 0.84 or 0.388 as I said. Now let's work together. Give me the answers. That multiplied by that, what do you find? That multiplied by that, what do you find? Let's places.
5.778.
5.778 or 5.78. This one is 106 DF. So now, be ready with your calculators to do some math. Please, can you simplify now? Let's simplify. So what we do is we say 106 multiplied by the discount factor equals 102 minus 5.78. Where is the 5.78 coming from? Is this one here. So I've taken this one on this. So let's go, give me the answer now. 106. What is the answer there? You subtract
96.22.
96. So then we divide 106 on both sides. 106. So let's divide. What's the discount factor?
0.907.
07 or 08.
0.908.
908.
08.
All right. So we're looking for a discount factor of 0.908 in year 2. What do you do? Back to your basics. 1 over 1 plus the power gives you 0.908. Same logic. Same logic. What logic is that? Some of you say, Mr. P, what logic? Make your life, take this to the top. Take this to the top. So we've got T, 1 plus R, the power 2 equals 1 over 0.908. So let's go. What answer do you have? Yeah.
One point 101.
1.1013.
1013.
Okay. To the power 2. So please, you take the square root on this side. How do you take a square root of the number? Don't panic. Here's how you take a square root of the number. I'm going to take a square root of this number of hours here. We're going to say 1.1013, the power 1 over 2. That's how you get a square root. So take your calculators and you say 1 What does that come to? What does that
1.049.
1.0494.
494.
So when you bring 1 on this side, the interest rate we are looking for is 0.0494 or 4.94%. This is the discount rate applicable to second bonds. That's the discount rate applicable to second bond. Bootstrapping, working backwards, using the figures that we have to calculate the missing figure. What do we mean? We are saying we know the sum of these values, and we know that one. We partly know that one. So we can find the discount factor, bootstrapping. I'm sure slowly you're getting the sense out of this computation. I'm sure slowly we are getting a sense out of this computation. So there we are. So we have 4.96, ours 4.94. After 4.4. What of the last one? Now, if you didn't follow the others, let's see if we can now work together. We now know year 1 and year 2 discounting factors have been established. Okay? 1 and 2 have been established. So now, what of the last one? Let's work it out together. Let's arrange the figure. So if you didn't follow me, please, can we make an effort to follow this time around? And you stop me. You stop me while you have a challenge. Just stop me so that I repeat it for you. So let us start our explanations. We've got a bond, which is expiring how long from now? We've got a bond, this one. Okay? Its market value is how much? It's 98. How are the cash flows? Let's arrange the cash flows together. Let's arrange the cash flows together. So we've got year 0, year 1, year 2, and year 3. What are the cash flows? The cash flows are, we've got 5, we've got 5, we've got 105. What are the discount factors? You have them, 0.963, was this 908? We calculated this?
Yes, 908.
908.
908.
908. This one is the one that you want to calculate now. This is what we want to calculate. And when you add up that one, and that one, how much are you supposed to find? Once you add up these values, how much are you supposed to find?
98.
Yes, 98. The 2017 question, the June 2017, was just based on this article. It's just a replica. So what you have done here is what you are going to do in question 4 of June 2017. That is what you're going to, so you're going to repeat this. So now let us fill in. Let's fill in our answers. 2 decimal places. The first one, how much is it?
4.82.
4.82. Next one.
4.54.
4.54. and that one 105. Okay, so let us arrange them now. So we are saying 4.82 plus 4.54 plus 105 df equals 98. So let's go then. So we've got 105 equals 98